pushed price all the way down lower, closing near the lows. What happened next is that the subsequent candle opened near the lows. The buyers stepped in and pushed price all the way back higher, even higher than the previous day highs, and then finally closing near the highs. You can see that this is a bullish engulfing pattern, because it has engulfed the previous candle. This is a bullish reversal pattern, a bullish engulfing pattern. One thing to note is that, the larger the bullish engulfing pattern, the more significant it is. Right now, I'm just going to walk you through and share with you an example. You can see over here, this is the year USD chart. You can see that the candle opened near the lows, and then closed above the previous candle open. To me, my definition of a bullish engulfing is that the candle has to be larger than the body of the previous candle. I hope you have an idea of how it is. Remember, never ever trade candlestick patterns in isolation. This means that if you see a bullish engulfing pattern on your chart, don't just blindly go long. This is not enough. It doesn't give you an edge in the markets. On the other hand, in the first candle, you can see that price has opened near the lows. The buyers stepped in and pushed prices all the way up and closed towards the highs. Then, the subsequent candle that has opened where it closed previously. The sellers came in and took price all the way down lower, finally closing near the lows. This is a bearish engulfing pattern because the second candle has engulfed the previous green candle. What it means is that it's a bearish reversal pattern. The sellers are momentarily in control. The key word is momentary, I didn't say permanently. The larger it is, the more significant the pattern is. Just to walk you through a few examples, you can see that there are three bearish engulfing, where it opened and then closes near the lows. Then the body of the subsequent candle is definitely larger and overcome the body of the previous candle. So, by now I hope you have a good idea of what a bearish engulfing pattern looks like. Again, just because you see a bearish engulfing doesn't mean you short immediately. You want to use a few technical tools together to increase the odds of your trade working out, which is what we're going to discuss now. So I want to introduce to you what I call the TAE framework. You can see that the price is above the 200 MA, so you should be buying. At the same time, you can see the area of value on the area of support where previous resistance turned support is for the entry trigger. You can see a bullish engulfing pattern at support. You can enter on the next candle's open and your stop loss could go a distance below the lows. We're not going to discuss too much about where to take profits and stuff like that, because this is really just an introduction to stock trading. But I hope I gave you a good understanding of knowing when to buy a stock. Again, the price is above the 200 MA, price is on an area of value of trend line support, and you can see a hammer candlestick pattern as an entry trigger. Now, these are cherry-picked charts. I've purposely picked those charts that show CU winning trades because I find it's easier to explain the concept. But when you're trading in the live market, trust me, there will be losers. No matter how good the fundamentals or technicals are. So I want you